Hello class, Chapter 7, Business Deductions and Deferred Compensation, Part 2. Qualified Stock Bonus Plan, the type of defined contribution plan where investments are the employer company stock. Common Stock Bonus Program is employee stock option plans, the ESOPs. The ESOPs are funded by both the employee and the employer contributions, and the employer can deduct dividends paid to participants. Participants must recognize income. The non-qualified plans used by the employers to provide supplemental retirement income to executives. The common forms, the executive supplemental deferred compensation plans, the employee contributes pre-tax salary to the 401k like plan. Distributions are taxable because it is pre-tax. Stock rights or transfers where there is a significant risk of forfeiture. They're not subject to discrimination rules under the qualified plan rules, so the non-qualified plan can favor the highly compensated. Non-qualified plans have restrictions on transfers of plan benefits to the employee, so the employee can delay recognizing income until monies are distributed. The employer takes a deduction in the same year the employee recognizes income. Employee stock option plans, you have the qualified incentive stock options, the ISOs, and then you have the non-qualified stock options. Plans for self-employment individuals, taxpayers who are EEs can also establish a KEO account if they are also self-employed. The defined contribution plan is the maximum contribution of the lesser of either $56,000 or 25% of the earned income. After self-employment taxes and deductions itself is taken into account, the taxpayer can actually contribute only 20%. The SEP IRAs have some same contribution limitations as KEO plans. Self-employed individuals can also select, instead of a KEO, a simple plan, solo 401k plan, or a SEP IRA. Other standard IRAs are available to self-employed individuals as well as the general public. And then the solo 401k plans allows for a $19,000 deferral plus a 25% salary match. The total limit in 2019 is $56,000. IRAs, individual retirement accounts, you have traditional, you have the Roth, and you have the covered out education. The differences on this chart, so you're going to see on the traditional, the maximum contribution is either lesser of $6,000, $7,000, or 100% income. For the traditional deductible, you have the lesser of $6,000, $7,000, or 100% of income, and then the lesser of is the $6,000, the $7,000, or 100% income for the Roth. There is no other limitations for the traditional. There is for the deductible. You're going to have a phase out of the existence, and there's also a limitation on the IRAs, but other provisions essentially remove income limitations. Contribution deductible, not for the traditional, but yes for both. Just for the traditional, and it's not deductible for the IRAs. Withdrawal-based taxable basis, yes, there is. And if the basis equals 0 for the traditional, no, unless the taxpayer takes out money early. Individual retirements, the IRAs, if the taxpayer elected married filing joint status, then both spouses can contribute, even if only one spouse has earned income. So the example they give is John and Abigail filing a joint return. They can contribute up to $6,000 each to an IRA, as long as at least one of them either has wages or self-employment income of $12,000. If wages are $8,000, then John and Abigail's combined IRA cannot exceed the $8,000. Roth IRAs, taxpayers make after-tax contribution. The amounts grow tax-free. Withdrawals are also tax-free under the following circumstances. You need to be at least 59 and a half years old, and the account has been established for 5 years. The taxpayer has inherited both. A Roth IRA is now receiving distributions. First-time home buyer can withdraw up to $10,000 to use that money, and the individual has become disabled. Phase-out thresholds. So when you're single, between $122,000 and $137,000. Married filing joint, between $193,000 and $203,000. Married filing separate, there's no Roth IRA contribution permitted. However, taxpayers are permitted to roll over traditional IRAs and convert them into Roth IRAs. Coverdell Education Savings Accounts. The maximum after-tax contributions is $2,000 per year. The child under the age of 18 can be used for elementary, secondary, or higher education expenses. Taxpayers can claim education credits the same year she takes a Coverdell distribution, but must reduce the qualified expenses first, and there's income limitations do exist. Health savings or HSAs. Taxpayers can contribute up to $3,500 for the self or $7,000 for the family into an HSA to pay for medical expenses. Contributions are deductible for AGI, grow tax-free, with distributions to pay expenses also tax-free. Right. HSA, taxpayer is covered under a high deductible plan. Taxpayer is not Medicare eligible. Taxpayer not also covered under a plan that is highly deductible, and it cannot be claimed as a dependent on another's tax return. Tax planning considerations. You have Roth rollovers, and then you have non-taxable fringe benefits. And that concludes Chapter 7, Business Deductions and Deferred Compensation. Thank you. Have a good day.